and this is my price action trading course. The current module is about trading a strong bull breakout. Remember, a strong bull, that phrase is identical to the word breakout, and that phrase is identical to the word spike, and all three of them mean that you should buy. So you should look for signs of a strong bull breakout when you think one might be happening. You'd like to see big bull trend bars, at least one, preferably several in a row, consecutive strong bull trend bars. You want to see small tails, preferably on the tops of the bars. You want the bars to be closing on their highs. And also the context has to be supportive of the market going higher. So for example, if you're in a trading range and you have two bull bars taking you to the top of the trading range, that's not likely to result in a strong bull breakout. That's more likely to be a buy vacuum test of the top of the trading range. So if you're in the spike phase of a bull trend, you have to get long, and you can't spend a lot of time thinking about it. You can always buy at the market, which is fine. You can buy at the close of any bull bar and any bear trend bar as well. If the market's going up and it forms a bear trend bar and you're in a strong bull trend, that attempt by the bears will probably fail. So the math favors buying the close of that bear bar and also buying below its low. You can also buy above the high of any bar. If the market's going up and it has a pause, you can buy above the high of that bar. If the market goes up 2 or 3 bars in a row, you can buy at the high of any of those bars as well. And you can press your bets and buy breakouts above swing highs. So if the market goes up and pulls back, you can buy as the pullback turns up, but you can also buy as the market goes above the prior high. And you can buy obviously any small pullback, a bull flag. The key is you have to get long. And everyone knows the stop is far away. When the market is racing up, your stop is far away. And that's scary to traders. Well, buy small. Don't think about it. Cut your position in half. Cut it into a quarter. Just trade 1/5 of a position, but at least get something on, and then look to add on later when you have opportunities. Since it's a strong trend, a breakout, you want to swing at least part of your position. During different times in the strong bull trend, you might want to scalp. For example, if you're buying closes, you might want to scalp those additional entries. When you do, you use a tighter stop, but wherever you choose for your stop, make sure that the reward that you choose is at least as big as your risk. And advanced traders, they can scale in. They can scale in as the market's going higher. They can scale in during a pullback as the market is going against them. Here's a weak bull breakout, and because it's a weak breakout, you have to expect that you might get a deep pullback. The market sold off sharply here and became always in short, probably on this bar or this bar, and it immediately reversed up after testing near yesterday's close. Yesterday was a bear channel, big gap up breakout, and 3 pushes down, 1, 2, 3. So this could simply be an opening reversal, a pullback from the gap up breakout above this bear channel. So we have a bear channel, bull flag, breakout, and then a very deep pullback almost down to yesterday's close. In any case, at this bar, you might think, oh, this is not good for the bears. A strong bull bar, big bar, close near its high, and then a follow-through bar. And then we have another bull breakout. Its close is above the high of the prior bar. So most traders at this point would say, yeah, I think the bulls are in control, and that this sell-off was just an opening reversal. It's just a sell vacuum test of support in the area of yesterday's close. So at this point, traders are always in long. So that means they're expecting at least a second leg up, and they're going to look to buy pullbacks. They can buy this close, they can buy above the high of the prior bar, they can buy for any reason, but their stop is below the bottom of the bull spike, which would be the bottom of this big bull bar, or possibly the most or the low, right? So some traders will say it goes below the bull bar, others will put it here. It doesn't matter. The further the stop is, the more likely you'll be successful. However, when you have a 3-bar bull spike that looks like this, small tails gapping up, this bar closes above that bar, this bar closes above that bar, this bar closes above this bar. We have lots of signs of strength that the breakout is strong. Most traders would not want the market to come back below the bottom of the spike. In fact, most traders would not want the market to fall more than a tick or so below the top of the signal bar. So anyway, when you're seeing the market flip to always in long, then you see doji, bull breakout, but a big tail, another bull breakout, but a big tail, more tails. At this point, you're thinking, yeah, this could just be turning into a trading range day. Big down, big up, big confusion. Confusion equals trading range. In any case, it's still always in long, so traders are expecting a pullback, but at this point, they're probably thinking the pullback will be deep, and it probably will be trading range type behavior, falling below prior minor higher lows. As long as it stays above the bottom of the spike, though, and as long as it does not clearly become always in short, it's still always in long, so you can buy for any reason. So we have a bear breakout on this bar. We have some follow through here. The bulls will say, yeah, it's okay, but it's not nearly as strong as this. It's still always in long. I'm going to buy the close of this bear bar. I'm going to buy the close of this bear bar. I'm going to buy above its high. And that's what the bulls are thinking. The bears, on the other hand, are thinking, well, we had a very strong bear breakout initially. We have another lower high. So we have a high, lower high, lower high, low, lower low, lower low. So at this point, we're still in a bear trend. We're forming lower highs and lower lows, a pretty broad channel. But in their minds, they're still willing to short. Maybe if it gets above this high or this high, they'll think, maybe a trading range and not a bear trend. But they'll still look to short. So all through here, in fact, all through here, both the bulls and the bears are active, and both you have to assume are profitable. You have to assume that institutions are profitable. And at any given moment, you have institutions buying and you have institutions selling, and both are going to make a profit. When the market is unclear, as it is today, right? Traders know, or the institutions know, that whenever it's unclear, the probability is around 50%, maybe even 40%. But in either case, any trade that they take, they know that they need to go for a reward at least twice as big as their risk to have a positive trader's equation, to have the math work out on the trade. So the bulls will buy anywhere through here, and they'll go for a reward twice their risk. The bears will sell anywhere in here. Who knows where their stop is? It may be all the way up here, right? And they'll scale in higher. So, they'll short here, and they'll short here, they'll short here, they'll short here. And, they're managing their trade. The bulls, they're buying, they bought all the way up through here. They buy here, they buy above here, they buy here, and they buy this bear breakout, and they buy this, right? So the bulls are buying, the bears are selling, but both sides are managing their trades. Probably most are scaling in. If you're a home trader, an individual trader, and you saw this always in long, you'd probably buy that close. You might buy this, but you'd look and say, yeah, it's good. It's enough to flip it to always in long, but it's not all that strong, so there probably will be a deep pullback. Had you bought this, you might have scalped out for 20 or 30 ticks, expecting a deeper pullback. Had you bought it and you did not scalp out, and you traded small enough, you would have looked to add on during a pullback. So you may have bought more here. If you bought here your full size position, and so you could not scale in long, and let's say you did not scalp out here, you'd hold long through this pullback and rely on your stop, looking for a second leg up. The market has an obvious second leg up here, but a 2-bar reversal, bear bar near the high of the day, probably at this point you're concluding the day is a trading range day. The follow through on the buying is just not good enough, so it's probably a bull leg and a trading range rather than a bull leg and a trend. So had you bought here, you probably would get out of your final position here, maybe take out half here and go to break even on your stop, and it looks like this came pretty close to testing the stop. So the point of the slide is, when you see the market flip to always in long, you have to be expecting a second leg up. We got the second leg up here. And if it's always in long, you can buy at the market as long as you put your stop in the appropriate location. If the stop is too far, you have to trade smaller so that your actual risk is the same. So, don't get upset. The market, this is the day that you have. You have to trade the market that you have, not the one that you want. Sure, you want a strong, much stronger bull breakout. You want the 5 or 6 bars closing way up here. That's not what you have. This is the market that you have. You have a weak bull breakout, but always in long, so we should get a second leg up. And you got it at this point. So whenever the breakout is not all that strong, you have to assume that there'll be a deeper pullback. And that's okay. It's still tradable. Okay, you have to decide early. Okay, so the context is good. We have a bull trend, a high 2 buy into yesterday's close, a strong first bar of the day, second bar of the day, bull bar, and then right above the moving average we have a very strong bull trend bar. So we have a high 2 buy. Here's the high 1, here's the high 2. So a high 2 pullback and a strong bull trend and a strong bull signal bar. A pretty good entry bar, tail not ideal, and then on the breakout to the new high of the day, we closed on the high tick. So we have consecutive bull trend bars following 2 other bull trend bars. We have a reversal up from the moving average. It's an opening reversal. We were up, we traded down, and we reversed up. And we have a strong signal bar over here. So this is a likely strong bull trend, and you need to get long. Remember, if a breakout is successful, it may go for many, many bars without any pullbacks. And if you wait for a pullback where you can enter with a smaller risk, you may end up missing a huge trend. You're never going to be more than 60% certain of any trade. The market lives between 40 and 60% probability all the time. Don't get paralyzed by the 40% chance of loss. 60%, that's as good as it gets. And if you're a trader, you got to trade. That's what you do for a living. And if you have 60% certainty of anything, you got to take the trade. Once you think that the market has become always in long, in other words, once you think that the bulls have control and that the market's going higher, put at least a small position on right away. On the close of a bar, at the market. It doesn't matter. You can see the module on breakouts and on trading strong trends to get other ideas. Should you wait for a breakout? Okay, at this point it's always in long, and there's a sense of urgency. The market's closing at the high here, many ticks above the high of this bar. This bar closed several ticks above the high of this bar. We closed at a new high of the day. We're in a bull trend. The market's going higher, right? So should you wait for a pullback? The pullback might not come until the market's way up here. So you cannot wait for a pullback. You have to get long. The institutions are buying. There's heavy volume in these bars. I didn't check, but I know that there is. So the institutions are buying heavily. If you want to make money, you have to do what they're doing. And they're buying heavily. You got to buy. Another bull bar. Yes, a little tail, but still a very strong bull close. So buy, where's your stop? You look at it and you say, well, my stop may have to be all the way down here, or maybe below the low of this breakout bar. That's right. That's where it has to be. Calculate how much you have to risk, and then trade appropriately small, but at least trade. Another bull bar, a little bit bigger tail, so we're starting to lose momentum, but you're still in a very strong bull spike. Stop probably below the bottom of the spike, maybe below this breakout to the new high of the day. Okay, decide early. I mentioned consecutive trend bars, reversal up from the moving average, opening reversal, strong signal bar, a follow-through bar, all right? Another follow-through bar, clearly a strong bull trend. Okay, you can buy closes. You can buy the close of any of these bars. You can even buy the close of this bar if you're taking it for a swing, because your stop is down here. During this pullback, you would not have been stopped out, and experienced traders would have added on. They would have bought more here. A second entry long, here's the first, second entry long at the moving average, wedge bull flag, 3 or 4 pushes down, so they would have added more here. They may have gotten out part or all on the test of the earlier entry, but they would have been buying. Again, closing on the high tick, closing near the high, another strong bull bar, another bull spike. Traders will buy closes. Even right here, even though it's a third push up, 1, 2, 3, a strong close, traders will buy closes. Once they see this, a strong bear reversal bar, they may place a limit order to get out break even, and they did over here, and that's what created this tail. A lot of traders who bought closes here were looking for an opportunity to get out without a loss. So when the market came back to their entry price, they sold out and had break even and will wait for a bigger pullback. They got a bigger pullback, and then the trend is resuming strongly into the close. You can buy closes here, here. Up here, yes, you can buy closes, but we're losing momentum. Body's getting smaller, tail's getting bigger near the old high. So I probably would not buy those. But in any case, the context over here and over here certainly made higher prices likely. Remember, a trend is made of two parts. It begins with a breakout, a spike, and that is a strong trend. And then it's followed by a channel, and that is a weak trend. Sometimes the channel is so vertical that it functions essentially like a breakout, and you should trade it like a breakout. But in my mind, it's still a channel, and a channel is still a weak trend relative to a breakout. A breakout is the strongest type of trend. So here we have a very, very strong bull spike, okay, a pullback, and then this is the channel phase. Even this channel phase has a strong spike in it. The channel is probably evolving into a much broader channel, and at this point, this entire thing is probably a bull channel, and it's likely that we're going to work higher in broad swings. So, strong bull trend, you want to buy breakouts from pullbacks. So the market's pulling back, you buy above the high of the bar. It's a swing trade, so your stop is down here or down here, so trade small. Another pullback, a high 2, you buy above the high of this bar. Swing trade, stop down here. Here, another pullback, wedge bull flag, 3 pushes, 1, 2, 3, bull inside bar. You can buy here, test of the moving average. Second entry, buy here. You can buy any of those. You can buy all of them if you trade small enough and make sure that the total dollars at risk is not greater than your comfort level. Your swing stop is down here, maybe below this breakout bar. Another pullback, small pullback, you buy here, right? So you buy pullbacks and you buy above swing highs. You press your bets. Here's a prior lower high. You place a buy stop 1 tick above its high and you buy up there. And same here, you buy here. You know, all of those are ways to get in. You don't have to take all of them. You don't even have to take most of them. But in a strong bull trend, you have to take at least one of them. You buy below bars in a strong bull trend. You assume any attempt by the bears to reverse a trend this strong is going to fail. So you can place limit orders at the low of the prior bar and get filled there. Here's a bar. You place a limit order at its low. You get filled there. You can buy below prior lows. So the market might break below this low. Well, if it does, buy. Here's another spike down. If it falls below there, buy. So you get filled over here. Another strong attempt by the bears. You have to assume it'll fail. If the market falls below it, buy. Okay? Another bull spike. You place a limit order to buy at the low of the prior bar, and you get filled there. How else can you get long? You can buy closes. You can buy bear closes. You can buy bear breakouts. Every attempt by the bears to reverse the trend will fail. You can buy that close. Here's another bear bar, that close. You can buy this close. You can buy this close. Again, relying on your swing stop. Here's a bear breakout, a strong bear bar closing below the low of the past 10 bars or so. But you have to assume bear breakouts will fail because it's a strong bull trend. And this failed. Instead of having another strong bear bar, it was followed by a bull bar, a failed breakout bar. Remember the trader's equation. There are 3 variables, and in a strong breakout, the probability is very high. But what's the trade-off? The trade-off is the risk is also greater. So yes, you have much higher probability, but the stop goes way down below the bottom of the spike, so your risk is much greater, and that's your trade-off. So you have to trade smaller. Okay, strong bull spike. you have several possibilities for your stop, no matter where you bought in here. Right? You could put the most conservative stop below the bottom of the spike. You could put a stop below the entry bar. You could put a stop below this breakout bar. Remember, this bar broke out above the high of the prior bar and above the high of the day. You could put a stop below the breakout point. This bar is where the trend accelerated, and it accelerated once it went above the high of the prior bar. So you could put a stop just below that. The further the stop, the greater the probability of success, but also the greater the risk. So if you're using a wide stop, you have to trade very small. And that's okay. That's exactly what you should do. Sometimes there's something going on in a stock that makes you want to be long, but the risk is too great. And option traders have an alternative to trading a very small size. So let's say you have a very large open profit, and the profit just keeps growing, and now your stop is very, very far away, and the total dollars at risk is much greater than you're accustomed to trading. So you know you have to reduce your position size. Beginners tend to look at their big open profits and say, hey, it's other people's money. No, it's not. It's in your account. It's your money. So you have to adjust your position size based upon your actual risk at the moment. And you can either greatly reduce your position size. If that makes your position size so small that it's not worth continuing to hold the position, you have an alternative. You could simply sell out of your entire position and replace it with an option strategy. And the obvious one, if it's a bull market, is to buy a call, or to buy a call spread if you're expecting a move that will go up for 4 or 5 or 10 more % over the course of the next several weeks. Then go ahead and buy a call spread. If you're expecting a more modest move, or if you're expecting a much faster move, a very sharp move up, just go ahead and buy a call. Other strategies like collaring up are beyond the scope of my intentions for this course, and I may deal with them in another course in the future. But right now, I do want to talk a little bit about what you do as an alternative to using a stop that's just too far away, and you don't want to trade too small, and buying a call. Sometimes if you either own a stock and the stop is very far away, or if you're thinking about buying a stock and the stop is very far away, you can have an alternative to simply trading very small, and options offer a very good alternative. Let me give you 2 examples. One is, let's say you bought a stock somewhere down here, the spider on the daily chart, and now it's up here. And let's say your stop is down here, and you've been scaling out, so now you're down to maybe 100 shares. But your 100 shares times $5, that might be more than you'd care to risk. That would be $500. You might say, well, I don't want to get down to 0. I still want to participate. Well, an alternative is to sell out of your spider's contract, or your spider shares, and instead replace your stock position with an options position. And an obvious one would be a call. Just buy an at-the-money call 1 month out or 2 months out. And so at this point, you'd be long a call. If you're looking to hold for 2 or 3 months, maybe for a 5 or 10% gain, you could go ahead and buy a call spread. But if you're thinking the market might just go up another 2 or 3% over the next few weeks, just go ahead and buy the call. Let's say instead of being long all the way down here, let's say you're flat for whatever reason and you decide you want to buy up at this area. You know your stop goes down here, and if that results in a risk that's too big for you, don't buy the stock, just go ahead and buy the call. You might be able to buy an at-the-money call, 3 or 4 weeks out for $2. In other words, times 100 shares, your actual cost would be about $200. Yes, you won't make as much as you would had you bought 100 shares of the spider, but your risk will be less. If you buy the spider and your stop is down here, you're risking $500 on 100 shares. If you buy a call for $2, your risk is $2. The most you can lose is $2. And yet you'll still have a good gain if the market goes up here. So Options provide an alternative to stocks whenever the risk is big. In other words, whenever your stop is far away. For those traders who did buy down here, if the market is up here, they can argue, well, I'm trading other people's money, and therefore I don't care if I lose $5. That's not true. Once the money's in your account, it's your money. It's not other people's money, it's your money. And you have to trade it as if you just put the trade on right here, not as if you put the trade on down here. You always have to mark your position to the market. So if you're long, it doesn't matter if you bought down here. If this is today and you're currently long and your stop is down here, this is your risk. It's not other people's money that's at risk, it's your risk. And you constantly have to be reassessing your position based upon your current stop, your current position size, and the current price. It's your money. It's always your money if it's in your account. Here's the 5-minute E-mini chart, and let's say for whatever reason you did not get long earlier and you decide to get long up here. You know that your stop is below the bottom of the bull spike, and you say, well, wow, that's 8 points away. I can't risk 8 points, and yet I only trade one E-mini contract, so I can't take the trade. Well, an alternative to doing that is to use options as an alternative. You could simply go ahead and buy an at-the-money weekly spider call, or if it's still too expensive, buy a slightly out-of-the-money spider call. Options are a very good alternative to stocks, and especially a big market like the E-mini or the spider. Spider calls have tremendous volume, and they're excellent alternatives to taking outright positions in the spider or the E-mini. Let's give it an alternate example here. Let's say you happen to buy here and you're still long here, and your stop is now 7 points away, and you don't want to risk that much, yet you think the market is still going a lot higher. You should be reducing your position size to keep the risk the same, but if it's too far away and you can't reduce your position size, instead of continuing to hold your E-mini and using a stop that might be too tight, like maybe below this bar, what you could do is simply sell out of your E-mini position and go ahead and buy a spider call, an at-the-money spider call, a weekly call, and that would be a very good alternative. Let's say you bought it and it cost 80 cents. Let's say you bought a weekly call. The most you can lose is 80 cents, which times 100 shares is $80. So the most you can risk is the most you can lose is $80, and if the market goes up for a measured move based on the height of this spike, you probably will make $80 by the end of the day. Anytime, you should always use position sizes that are correct for the size of the stop that you're deciding to use. What happens after the bull makes a new high? You have to be thinking about trailing your stop, tightening up your stop. Whenever you raise your stop from a prior stop, that's called trailing your stop, and you usually trail your swing stop to just below the most recent significant higher low. Every time the market makes a new high, raise the stop up to below the most recent higher low. If that higher low is too far below, maybe trail the stop to below the most recent very strong bull trend bar, or some other support level, like a few ticks below a trend line. You can also use a money stop. For example, if you're trading the spider, you can trail a stop 20 ticks below the most recent high. You can also move your stop to break even, and then not worry about trailing your stop after that. Just rely on your break even stop and assume that the trend will just continue. So the market here made a new high. Your original stop was somewhere down here. So what do? A new high, you raise your stop to the most recent higher low. Okay? New high up here, raise your stop to the most recent higher low. End of the day, I would not allow a stop down there, especially since at this point the market's transitioning into a trading range. But if this were earlier in the day and I was buying this as a bull channel, I would move my stop to below the most recent higher low, because as long as the market's making higher highs and higher lows, it's in a bull trend. And if you're swinging, you're assuming it's in a bull trend. Eventually, a breakout evolves into a channel, and a channel evolves into a trading range. Once it does evolve into a trading range, you trade it like a trading range. You buy low, you sell high, and you scalp. What does sell mean? Sell could mean sell out of longs, right? So if you're in a bull trend and it's evolving into a trading range and you're near the top of the trading range, you can sell out of your longs, right? You don't have to sell into shorts. Buy low, sell high. Sell high can mean simply sell, once the market gets high, sell out of your longs and look to buy again lower. Should you reverse to short? In general, no. If the market's still always in long and the trend is still reasonably solid, I would not short, or I'd be careful about shorting. Any short is a scalp, so your profit is not very big compared to your risk. Also, if you're trying to reverse, it's hard to be objective. For example, if you're long, all you're thinking about is the bull case, it's hard to instantaneously on the very next bar totally change your perspective and make the bear case. So in general, when I'm trading, if I'm long and I'm looking to get short, I get out of my long and wait for 2 or 3 bars until I feel like I'm objective again, and then look to do shorts. Also, technically, mechanically, it's hard to do 2 things at once. Get long, get short, and make sure that you handle your orders properly. Alright, so here we got a strong bull breakout and a new high, but on much less momentum. 3 pushes up, 1, 2, 3, so maybe a wedge higher high, and possibly a major trend reversal. We have a bull trend, a break below the bull trend line, here's the bull trend line, a break below the moving average, and then a weaker rally to a new high. So technically this is a higher low major trend reversal. Here's a double top bear flag, right, after the higher high. So it's a small lower high major trend reversal after this higher high major trend reversal. Okay, should you be thinking about shorting? If you're long, I would simply get out of longs, right? The market is evolving into a trading range since over here. It's in a tight trading range here, and the bears have a case to be made that it's a reasonable swing short for a major trend reversal. That's enough for me to get out of longs. Should you reverse the short? And if you're long and looking for a possible short, for me it's easier to exit my long and then take 2 or 3 bars to evaluate the situation and then look for the shorts. This is what I was talking about. You have a bull spike, a bull trend, a break below the bull trend, so a possible higher high major trend reversal. You have a smaller bull trend up here, a trend line, small trend line break, and a possible double top lower high major trend reversal. So for the bears, so if you got flat somewhere in here, you might think about taking a swing short up here. You can say, well, Al, the probability might only be 40%. That's fine. If the reward is twice the risk, it's a good trade, and you probably will be targeting some kind of test down here, so the reward would be at least twice the risk. So that would be a reasonable short, despite the bull signal bar. If you're eager to get in during a bull breakout, for example, if the 5-minute chart has a strong breakout and you don't want to enter too far, you don't want to wait to enter on the close of the bar because you're afraid as that bar gets bigger and bigger and bigger, it's getting further away from where you have to put your stop. You have an alternative. You can look at the 1-minute chart. You can buy on the 1-minute chart. So if the 5-minute chart has a strong bull spike that continues to grow, you can turn to the 1-minute chart and look to see how it's doing. If you see 4 or 5 consecutive bull trend bars, just buy the close of the bull trend bar and put a stop below the low of that 4 or 5 bar bull spike. You can also place a limit order to buy at the low of the prior bar on the 1-minute chart, and again risk to the bottom of that 1-minute spike. Here's an example. Here's a 5-minute chart on the left, a 1-minute chart of the same thing on the right. And you can see a very strong bull spike here, close on the high, big bar closing on its high, right? So if you don't want to wait until the bar closes to buy, as this is forming, you can look at a 1 minute chart. And if you see this, 1, 2, 3, 4 bull bars, just buy the close of that bull bar and put a stop below the bottom of the 4-bar bull spike. Okay, we're still continuing higher. So now we have about a 10-bar bull microchannel, 10 consecutive bars without a pullback. Probably the first pullback will be bought. So you can start placing limit orders to buy at the low of the prior bar, and you would have been filled right here. Again, stop below the bottom of the spike. The market starts to turn up. You can scalp out if you want, based upon your actual risk. Make sure to go for at least 1 point in all cases. But to me, the 5-minute chart is a swing, so I would not be scalping out for 1 point. I would try to get more than that. Setups, they never look good enough when the market's in a trend. In a strong bull trend, the market spends most of its time near the top. It doesn't pull back very much. But beginners want pullbacks. You got a strong bull trend, they'd like to see a small pullback, and they enter here and then put a stop right below the pullback because they want to have a smaller stop and smaller risk. But the pullbacks don't come until the experts start to take profits, and the beginners end up missing the entire trend. Experts buy for any reason. They know that most reversal attempts will fail when you have a strong bull trend. And they also know that the trend may go a long way before there's any kind of a pullback. So they just keep buying all the way up. So they capture a lot of the bull spike. They also buy small pullbacks, a high 1 pullback, a high 2 pullback, small bull flags. The market may make 2 or 3 high 1 pullbacks before it weakens enough and forms a high 2 pullback. So they just buy those high 1s, confident that even if the market becomes more complex and has a bigger pullback, they can scale in lower and get out around their original entry price, break even on their first entry, and with profits on. When the market's in a strong bull trend in the breakout phase, at some point it starts to have pullbacks and transitions into a channel. The first pullback is usually a high 1 buy, and sometimes the high 1 buy setup does not look all that strong, and traders have to decide, is the bull trend forming an exhaustive buy climax and about ready to reverse, or will the market probably continue higher? And that creates a problem for someone deciding whether to buy the high 1. In general, if you look at a high 1 and a strong bull trend and you're not sure whether or not it's the end of the trend or it'll be profitable, I think it's worth taking the trade. But once the trade starts to go your way, set the profit target at 2 times the actual risk. If the high 1 is very clear and very strong, you can scalp part out at 1 times actual risk. But if it's all that clear, the market probably will be good for a swing up, and you probably should let at least part of it ride. Here's an example of an exceptionally strong bull trend. Gap up, very strong bull spike, and then there's an attempt to reverse a strong bear bar, but the reversal never triggered. Instead, we got a small bull inside bar. So, and also these bars are closing right at their high, so there's a lot of urgency on the part of the bulls. They're very eager to buy. So when I look at this, I think, yeah, that's a very high probability high 1 buy setup, and we'll probably get a measured move based on the height of this spike. So my initial risk is 1 tick below, assuming I'm scalping, my initial risk is 1 tick below the signal bar. My entry price is 1 tick above. If I'm going for a scalp, should I really be going for a profit target at 1 times my risk, or should I be going for more? When the trend is this strong, I think it's better to go for more. Here's a setup that is not as clear. We have a strong bull breakout here, and then 2 bars with tails and small bodies, some loss of momentum, and then another surge, another big bull trend bar closing near its high. So might be an exhaustive buy climax in the end of the trend. And then we have a bear bar with a tail, big tail, small body, another smaller bear bar with small tails. The market might be entering a tight trading range, and if it's a tight trading range, it probably will have failed breakouts above and below, as it did over here at the top. So traders have to decide how to handle this. In general, what I do is I buy a part, sometimes a full position, more often a smaller position at one tick above the high of the bar. If I'm going for a scalp, I don't want to allow pullbacks, so technically I'd put my stop below either this small bar or that small bar. More often than not, I put my stop, I use a swing stop, below the most recent very strong bull trend bar or below the most recent higher low. Even though this is not really a higher low, it's the bottom of this spike. So for me, I probably would put my initial stop here and then plan to adjust it if the market goes up. If instead it pulls back, I probably will add on, double the size of my position, and then try to get out of everything around break even, around my initial entry price. Instead, we got a parabolic curve up and another bull breakout, another big bull bar, smaller than this spike and smaller than this spike. And this one has a bigger tail on the top relative to the size of the body, and another bear bar. So traders have to decide again, are we getting near the end of this move? Is there going to be a good swing up, or are we going to get a substantial pullback, maybe two legs down to the moving average? This is the third push up on the day, and it's the third consecutive buy climax, and each climax is getting smaller. We had this very large bar here, followed by another good bar. Here we had a big bar, but smaller, and follow through is weaker. And here we had a smaller big bar, and again follow through is weaker. And again, to me, I would look for the bottom of the spike for the protective swing stop. Maybe the low of this bar, probably more the low of this bar. This close is above that high. We had trading range behavior here, small bars with tails, and then we had a breakout, close above the high. The low of this bar is above the high of that bar, so we have a micro gap in here. So for me, the swing stop, a reasonable swing stop, would be below the low of this bar, and that would be my initial stop. When you look at the distance, that determines your position size. You can either take a full position. More often than not, I take a smaller position, and if the market goes sideways and pulls back a little bit, I'll put the rest of the position on, and when that happens, I try to get out of everything at break even. If instead it goes directly up, I'll be taking profits. Here, this is the third push up. The bull is getting weaker. I would be much more inclined to scalp here at either 1 or 2 times the initial risk, or actually it would be the actual risk, because, well, it could be the initial risk. I'm assuming the market went below the bear bar and then above the bear bar, but you don't know. It may have gone above, then below, and then above again. So to me, the actual risk was 1 tick below. Actually, that might be a micro double bottom. They may be at the same price. I really can't tell. But anyway, the initial risk and the actual risk is certainly below the low of this bar. Initial risk is down here. And once you had the close of this bar, you can feel pretty confident that your initial risk is here. So you buy here, your initial risk is 1 tick below. And with the market as strong as it is, it might be worth trying for 2 times the initial risk. To me, I could see even going 1 time the initial risk. Probability is high that the market would go up at least some. I don't know that it's high that we would have another big swing up at the moment. Okay, here we have another very strong bull breakout. But there's something very different with this breakout compared to the one on the prior chart. Again, very strong, a big series of bull bars, very big bodies. Okay, what's different here is look to the left. You always have to look to the left. Right? And here we have a double top, and we raced up here with big bars, testing that double top. So to me, it's possible that this is simply a buy vacuum test of resistance, and that the market will evolve into a big trading range. Look at the signal bar, a doji bar, so a less reliable signal bar. It increases the chances of sideways, which the market did, and that big tail at resistance increases the chances of sideways. But let's say, in general, I probably would not buy a high one right below resistance, but I think it's okay to buy this. However, if I did buy it, my initial stop would be down here, and I would have to trade a position size that's appropriate for that. And also, since I probably would be willing to scale in, I probably would take half of the appropriate size. So let's say you normally trade 400 spider contracts, all right? And you normally risk 20 ticks. Here you have to risk 40 ticks, so you might buy 200 contracts, 200 shares of the spider. But since you want to scale in lower, you may just buy 100 shares, right? So your initial would be 100 shares, 1/4 of your usual size position, and you'd see that the market hits your stop, you'd get stopped in, you'd be long on this bar, but then it broke sharply down here. For me, I would usually look to scale in below, put the other 100 shares on in this example, either at the low of this bar or on a high 2. Here's a high 2 buy. In either case, I would keep my stop down here, which is probably risking more than I should. I might move my stop to below here once I put the second half on. However, what's different now is we have a strong bear bar. We have 2 more bear bars and a tail. To me, I would probably try to get out around my original entry price if the market got there. All right. So if I bought here above the signal bar, and let's say I bought more above this bar, right, I would be holding long. I'd see this, and I'd see this 2-bar reversal, and I would be nervous. However, I still think the market's always in long. It looks like this bull bar double bottomed with this bar, but it triggered the 2-bar reversal. However, tight trading range, I don't want to be shorting at the bottom of a tight trading range in a bull trend. So I would not have shorted, and I would not have gotten out. However, when the market resumed up, we have a big tail, right? And then we have a small bar with a tail, right? This is not going up. And I bought here, and I added on maybe here, or maybe 20 cents below. I often add on at a fixed number of ticks below. And the market's trying 1, 2, 3. It keeps trying to get up there, but it's not fully getting up to this price. It looks like it got to the close, but not above the close. So if I placed my limit order to get out at that close, I would not have been filled. If I placed it at my entry price, 1 tick above this bar, I would not have been filled. In general, when that happens and it's making repeated attempts, I just look at the average entry price from my position and then try to get out break even, or maybe a tick or 2 better than break even. So somewhere here when it turned into a tight trading range, I would say, I've given it enough time and it's not giving me a profit. Something's not right, and we're right at resistance. So for me, somewhere in here, I would get out of the entire position at break even. For me, I actually would not have bought here. I probably would have bought here, but I would not have bought there. And had I bought here, I probably would have gotten out around break even somewhere up in here. After several pushes up, 1, 2, 3, I would just give up. Too much risk of a small double top and then a bigger sell-off, which is what ultimately happened. So it's a high 1. You can buy it, but if you buy it, I think management is key, and I would buy small with the intention of adding lower. Had you bought here and you got this kind of behavior, tight trading range right below resistance, I would get out at break even. Here's another possibility of a high 1 buy. Technically this is the high 1. I think you could buy above the high of this bar. You could argue that this is a small high 2, but it's the same entry price as the high 1. But let's say you bought above the high 2. Okay, your initial stop would be theoretically below the most recent high or low down here. Realistically, we have a new breakout here, right? This close is above that high, so it's a breakout. So to me, I would probably put my initial stop here. So if my initial stop is for my entry price up here, and to the risk down here, I'm risking about 40 cents. If my normal risk is 20, I would trade no more than a half size, maybe a quarter size position. So let's say I bought here or I bought here. I'd be trading small. Right here, I think it's a 50-50 trade. I would want to go for a reward twice my actual risk. The market tried to turn up here, did not turn up yet. Did turn up here with a decent bull bar. So at this point, you can determine the actual risk. It's 1 tick below the lowest point from entry. So you entered here. Let's say you entered here. Your actual risk is then 1 tick below that bar. And 2 times actual risk would be up here. A second entry, double bottom, probably higher probability. And I personally would convert part of it to a scalp equal to 1 times risk. Whenever a trade is questionable in terms of much follow through, but the probability is high, a high 2 and a bull trend, a lot of times I'll scalp just for 1 times risk instead of 2 times risk. So had I bought here, it would be a high 1. I'd probably initially go for a 2 times risk, but then once it formed a double bottom, the probability I think goes up. A high 2 is more likely than a high 1 to be profitable. So at this point, your trade is more likely to be profitable. Your actual risk you now know is here, so you could go for 1 times risk. If you were still going for 2 times risk, for me, I would exit below this bear bar, maybe with a small profit, a few ticks profit. So that is a strong bull trend, not quite as strong as the other two, but unlike the prior trade, it broke out above the bars to the left. So this is not the top of a trading range. This is a breakout and a bull trend. Second or third entries. All right, huge gap up, strong bull spike, trend from the open bull, small pullback bull trend day, extremely strong. Here's a high 1, you buy. High 1, this II, you buy. And goes above the high of a bear bar. This bear bar is a small pullback attempt. You can argue it's a double bottom, 1 push down here, 2nd push down here. You buy. You buy for any reason, especially looking for high 1 and high 2 pullbacks. 2 little pullbacks here, 1 and 2. You can call it a high 1, you can call it a high 2. This double bottom, you can call it a high 2. You could say it's a pullback from a new high, you can call it a high 1. It doesn't matter. You got to be buying small pullbacks when the market is this strong. In trends, setups never look good enough, and beginners are always waiting for the perfect setup, and it never comes, and they end up missing the entire trend. Traders always want to buy lower so they can have a smaller risk. Here's that same series of charts, and a beginner will look at this and say, uh-oh, we're topping out. We got an II, final flag, and we're probably going to pull back all the way to the moving average. I don't want to buy up here. I'll wait to buy at the moving average. Instead, experienced traders are saying, wow, a huge gap up, 6 or 7 bars up. I need to buy. I'm going to buy the market, or I'll buy the low of the prior bar, or I'll buy above the high of this high 1. You can call it a high 1, you can call it a high 2, doesn't matter. But the experienced traders are going to get long. Okay? Doesn't look like much, right? But the context is great. You have a gap up and a strong bull spike. This could be a huge, strong bull trend day. So this is certainly an excellent swing long. Where's your stop? Probably down here at the bottom of the spike. Maybe below, somewhere down in here, 2/3 of the way down. It doesn't really matter. You have to be trading small, confident that the market is going to go higher. All right, now we got another bull spike. The traders who bought here are feeling pretty good. The beginners who did not buy here are saying, oh darn, I missed it. I'll wait for another pullback. The experienced traders are looking at that and saying, that is a pullback. Strong bull spike, small pullback trend day, the strongest type of trend day. I'll just buy and put my stop below the most recent higher low. Bear reversal bar. Beginners are saying, yes, we got 3 pushes up on the day. First bar of the day, over here, over here. We're finally topping out. I'll finally get my pullback. In fact, what I'll do is I'll be clever. I'll buy my pullback, but right now I'll take this short, 3 pushes up. So I'll take the short, and then I'll buy the pullback when it forms, and I'll make 2 profitable trades. Experienced traders are saying, the biggest pullback was just a few ticks here, just a couple points here. These pullbacks have been small. This pullback probably will not be big enough to make a profit on a short, so I'm only going to look to buy. We got 2 bars down, 1, 2. This may even be a micro double bottom, and if it is, you can even buy above the high of this bear bar. All right, beginners, they took this short. Where's their stop? Above the high of this bar. So what happens if the market gets above the high of this bar? It's probably going higher. So experienced traders will buy that. And beginners are saying, darn, I thought for sure I would be able to take my short, make a profit on my scalp, and then reverse to long. Experts have a hard time reversing to long. So for a beginner to think that he's going to take the short and then reverse to long is way too much to expect. He should only be looking to buy and give up taking the counter trend scalp. All right, beginners are saying, okay, we're starting to get two-sided. We have a bull spike here, another spike here, another spike here, consecutive buy climaxes. The market has to pull back. I'm not going to take this buy. I'll wait until we come back, maybe to here, maybe to here. Experienced traders, small pullback bull trend day, strongest kind of bull trend day. Even if we do pull back, we'll come back up here at some point in the next 10 or 15 bars. I'm only going to buy. Maybe I'll put my stop below the most recent spike. Beginners, okay, second entry short, a 2-bar reversal. We're certainly getting back to the moving average this time. This time I'm going to short and I'll reverse at the moving average. Experienced traders, the biggest pullback has only been a couple of points. This probably will only be a couple of points. There's no way I'm going to short. I'm either going to buy above here, a double bottom, so a high 2, or I'll buy any other pullback, but there's no way that I'm going to short. And the experienced traders made more money. Beginners, 3 pushes up, 1, 2, 3, small micro wedge here, way overdone bull. It's certainly going to pull back to the moving average. I'm going to short again, and I'll reverse to long at the moving average. Experienced traders, small pullback, bull trend day. I'm going to buy for any reason. I'll buy at the below bars, I'll buy above bars, I'll buy at the market, I'll buy pullbacks. And I'll rely on a swing stop at this point, probably below this spike. All right, that is the end of my module on trading a strong bull breakout.